We have given those that want to enter 5 minutes to enter the class. So I guess we can commence our class for today. Good evening to you all, and I welcome you again to our second class in financial reporting. No, these are our third class. Our third class in financial reporting. In the first class, we started with regulatory framework and ethics. In the second class, we started with conceptual framework. And today, we are going to finish up with conceptual framework, and we're going to start a new topic today, which hopefully we are going to finish tomorrow, if time permits. If we can't, that means we're going to carry it over to next week for us to finish. Remember that the topic for our class 2 was conceptual framework. And I told you that this conceptual framework, they are the set of principles that underpins the development of IFRS. In fact, I told you that the conceptual framework provides the basis for the development of IFRS. They are what we use to develop IFRS. They are the set of principles that are used to develop IFRS. We looked at the advantages of this conceptual framework. We also looked at their disadvantages. And we moved on to the purpose of this conceptual framework, looking at its usage to each parties that needs it, like the IASB, like the preparers, like other users, national standard setters, the interpretation committees, the auditors. Thereafter, we moved to the content of the conceptual framework itself, where we looked at chapter 1 to chapter 8. And I can remember vividly that we stopped at chapter 5 last week. Today, within few minutes, we are going to finish up with the remaining chapters. Then we'll solve some past questions. We'll see how I can have been asking questions in this area. For chapter 1, it looks at the objective of a general purpose financial report. And we mentioned that the objective is to provide financial information about a reporting entity that is useful to potential and existing investors, lenders, and other creditors to enable them make decisions about providing resources to the entity. We broke down this definition. I told you about the financial information we are talking about, which is asset, liabilities, income, and expenses. I told you about the accrual basis of accounting. And I told you about the primary users of financial information, who are the investors, lenders, and other creditors, and also their information need, what they need those information for. We moved on to the most crucial part of this conceptual framework, which is the qualitative characteristics of financial report. When I say most crucial part, it means that most often than not, this is in chapter 2, you find I can asking you questions often. Chapter 2, almost diet in, diet out. Because this one, they can easily pick questions from here, not like the other ones. So for the qualitative characteristics, we said there are two qualitative characteristics of a financial report. We have the fundamental characteristics and we have the enhancing characteristics. For the fundamental characteristics, we said these ones makes the report useful or not useful. If a financial report has these characteristics, then it is useful. If it does not have it, it is not useful. So there are two fundamental characteristics. There is relevance and there is faithful representation. We explained what relevance means. And the interesting thing around relevance is the predictive value and confirmatory value. Because we said for a report to be relevant, it must be capable of making a difference in the decision that is made by user, which means that it must have predictive value and confirmatory value. And I gave you examples of how financial information has predictive value from disclosing continuing and discontinuing operations to presenting material items separately in the report to disclosure or calculation of diluted EPS in the report. Then I finally ended up with explaining materiality. That the relevance of the reports will be affected by the materiality of items in the report. Then we moved on to faithful representation. I explained the three core items in faithful representation, which is complete, neutral, and free from error. And I also told you about measurement uncertainty, that before you can present faithfully or represent faithfully, you must ensure that the level of measurement uncertainty is low. Yes, we make estimates when we are determining our figures, but you need to provide the basis of those estimates. You need to ensure that your estimates are backed up by appropriate data. Don't just make estimates. No. And I also mentioned that there is substance over form. In fact, there is no way an entity can faithfully represent if it does not account for its transactions in accordance with its substance over legal form. And substance over form, I explained to you, really means that we record and recognize economic and financial reality and not the legal form. Usually, economic substance and legal form will be the same. Mostly, they are the same. But there will be difference where you have a scenario where ownership is different from usage or control, where you have an asset and the person that owns the asset is different from the person using the asset. Then substance is different from form. In that case, the person using the asset, even though it's not his own, you will still put that asset in his books. That's economic substance over form. The asset is not your own, but you can put it in your books. Or when you sold an asset or you sold an item and you are still using that same item that you said you sold, economic substance says you cannot recognize sales because you are still using it. How can you then say you have sold it? You cannot recognize revenue. Then we moved on to enhancing characteristics. We said there are four of them. Comparability, we have timeliness, we have understandability, and we have verifiability, which we explained to you. And in ending chapter 2, I told you about cost constraints. That when you're meeting these qualitative characteristics, ensure that the benefit you get outweighs the costs. That's cost constraints. The benefit outweighs the costs. Chapter 3 talks about financial statement and the reporting entity. We looked at what a reporting entity is. We looked at what a reporting period is. We then mentioned that consolidated report provides more information to users than unconsolidated. That is for entity that has subsidiaries. It's really important that they prepare a consolidated report because it gives user more information. Then we looked at perspective to the financial statement, that the report should be prepared from the perspective of the reporting entity and not from the perspective of the investor, because that will lead to bias. It's not what the investor wants or are expecting. Is your economic activity you have to report. Then we talked about going concern. The reports are prepared on the assumption that the entity will continue to operate into the foreseeable future. Then chapter 4 talks about elements of financial reports. Here we explained the 5 elements, which are asset, liabilities, income, equity, and expense. We defined assets, we defined liabilities, equity, income, and expense. And it's really important that at your level, you need to know these definitions by heart. It's very important. We ended last week with chapter 5, where we talked about recognition and derecognition of these elements. We said recognition is inclusion of the elements into the financial statement if they meet certain criteria. Number 1, we said they must meet the definition of those elements, and the element must be relevant and must be faithfully represented. Then we looked at the recognition, which is the removal from the financial reports, especially where for asset, where there is a loss of control of the asset, and for liability, where there is settlement of the obligation. So now, today, let's quickly finish up, because we were supposed to have finished this topic last week, but it's taking longer than expected. Let's quickly finish up this in the next 30 to 40 minutes. We have measurements. And measurement really is like the attachment of monetary value to the element of financial statement. Meaning that these items you are recognizing in your financial statements, how much should you put it in your financial statements? That's measurement, getting the value. And in reporting, when we are talking about measurement, there's something we call measurement basis. We work with measurement basis. And there are 2 measurement bases that we have. We have the historical costs basis, and we have current value basis. These are the 2 bases of measurements we have according to the conceptual framework, and you will see that these are the bases that all the standards would use. It's either of the 2. When an element is measured using historical cost basis, it really looks at the amount an asset was acquired, or the amount a liability was originated. How much did you borrow the liability? Or how much did you buy the asset? And this is a very popular basis in reporting, historical costs. So accountants, we usually measure asset and liabilities at the amounts we bought the assets or how much we actually borrowed. That even if you have bought an asset like 10 years ago, today you will still be putting the asset in your books at the amount you bought it 10 years ago. That's the nature of historical cost basis, and it's still allowed. I mean, is a measurement basis we have here. It's still allowed. Now, the new one is the current value basis. And a lot of the new standards now that they are issuing is really moving towards this current value basis because of the problem of relevance that historical cost basis has. Historical cost basis might not be able to make any change in our decision in the sense that you are using a stale value, a value that does not change, a value that is no longer relevant. So current value basis is correcting that. Even the current cost basis, so I said current value basis starts with the amount an asset was acquired, and as the amount an asset was acquired, or the amount a liability originated or was originated, but which is usually updated with the changes in economic environment and price levels. So when there are changes in economic environment, when there are changes in price level, this is updated. So if you bought an asset 2 years ago for 20 million and the value is now 30 million. So if you are using a current value basis, we want to see 30 million in your books. So current value updates that value. But when we are speaking of current value, there are 3 bases for current value because it depends on the situation or the transaction that will determine the current value you want to use. If, for example, you want to get the value of an asset today, of a similar asset, probably maybe you want to replace your asset, or you want to fair value your asset. You want to know what's the value today. You just want to do a valuation. You are using a revaluation basis. That current value is called current costs, which is similar to present value. If you want to get the value of your assets today, we call that current cost. However, if you want to sell your asset, you now want to know how much can I sell the asset? What's the current value of this asset if I want to sell it today? You use the current value terminology for that is fair value. That is the amount you would receive to sell an asset. For current cost, you are still using the asset. You just want to have an idea. Yeah, what's the value today? This one you are not selling. But fair value is used when you want to sell the asset. However, when you want to if you continue to use an asset, you now want to know what's the value, what's the economic value that you can get from this asset over its remaining useful life. That if I continue to use this asset, what is the value of these assets? What's the economic value of these assets? That's also current value, but we call that value in use. This one, there's a way to calculate it whereby you would discount the future cash flows from that asset. You would discount the future cash flows from that asset. You will learn all of these valuation as we move on in this class. You will learn everything. But you just need to be aware of them for now, that these are the measurement bases we have. At the top level, we have historical cost basis and current value basis. And under current value basis, we have current costs. You want to get either the replacement cost of the asset or you want to revalue it, or you want to sell the asset and you want to know what's the selling price, how much would you receive if you sell, or you want to know the economic value of this asset, that if you continue to use it, what will be your benefit over the remaining useful life? That's the value in use. And that's the end of chapter 6, talking about measurements. Chapter 7, this talks about presentation and disclosures. And this is saying that the elements that you have recognized and measured in our books has to be properly presented and disclosed in reports. Reports like our profit or loss statements. You are free to call it any name you want to call it, but it's popularly called statement of profit or loss. But this conceptual framework says that your income and expenses should be presented in a profit or loss statement. And even IFRS 18 has even changed the format of this profit or loss statement. But at least conceptual framework has laid the foundation, so they can present it however they want to. But there's a profit or loss statement. And there's another statement called other comprehensive income, where the conceptual framework recommends that when you have unrealized gains, that these unrealized gains or income should go to other comprehensive income. So when you have a kind of a revaluation gain, when the value of your asset goes up, like what is happening in our country before, if you had bought your car like some 2 years ago, a car that you would have bought, let's say 10 million 2 years ago, now is over 20 million. It's close to 30 million. So you have a gain. But that kind of gain, if you are still using that asset, yes, you have made a gain, but it's an unrealized gain. It's not a gain you want to be parading in your books as a business that you have made a gain. You don't put such a gain in your profit or loss. You don't put it there yet. You would actually put it in an other comprehensive income. All of these you are going to learn. We'll teach you how they are recognized, how they are measured, all of that. But this is like the foundation to have an idea of how they work. And also, it's possible that an unrealized gain can become realized. Yes, it can become realized. When they become realized, then yes, you can then take it away from other comprehensive income to where you would actually call it a gain that you can then enjoy. We call that recycling. That's the terminology. You take it away from OCI to either your profit or loss or directly to your retained earnings. So you recycle it. That's the whole story around chapter 7. And chapter 8 is talking about the concept of capital and capital maintenance. Concept of capital and capital maintenance. So two things here. The first one is the concept of capital. There are two concepts of capital. We have the financial concept of capital, and we have the physical concept of capital. So when we mention capital in reporting, Conceptual framework is saying, want to explain to us what that capital actually means. So it's giving us two options when you are preparing your reports. You can either look at capital from the financial perspective, which is the nominal capital, or the amount introduced into the business to run the business. I mean, if you bring in 10 million, 100 million, 1 billion, that's financial capital. But we can also see capital from another angle entirely by looking at capital as the productive capacity or the operational capability of a business. Looking at capital as productive capacity or operational capability of a business. That we are not seeing capital as money, but we are looking at capital as what you can produce. In fact, what that money can produce. Instead of looking at capital as money, we look at it maybe 10,000 units or 70,000 units, something like that. That's physical concept of capital, focusing on the productive capacity or the operational capability of a business. Now, then chapter 8 talks about capital maintenance. When have you maintained your capital? You see, a business has maintained its capital when the business makes profits. Any business that makes profit has maintained its capital. And when have you made profits under financial concept of capital? Because as soon as you have made profits, it's assumed that you have maintained your capital. Very straightforward. If your opening capital is 10,000 and your closing capital is 12,000, it's assumed that you have made a profit of 2,000. You have maintained your capital. But for physical capital maintenance, under physical concept of capital, you have only maintained your capital, which you call physical capital maintenance, if let's say your opening capital is 10,000 and your closing capital is 12,000. But well, there was an inflation. In the inflation rate for that year was 25%. The inflation rate for that year was 25%. So have you actually maintained your capital in this case? Because with inflation, it means that your opening capital, it actually will have been bloated by what's so your physical opening capital is actually 10,000 times 1.25. And how much is this? 12,500. And assuming your closing capital as it is today is 12,000, it means that this entity has actually made a loss of 500. This guy has not actually maintained his capital. He hasn't. Or alternatively, this is how I can mostly ask it in the exam. But alternatively, we could say that if your opening capital of 10,000 could produce you 1,000 units, but because of inflation, this 12,000 can only do 900 units. If we are looking at it from the unit perspective, this company has not maintained its capital because its productive capacity and capability has reduced drastically. So it hasn't maintained its capital. And that's chapter 8, talking capital and capital maintenance. And that's the end of conceptual framework. Now, before we leave this topic, let's go to our handout to solve some questions. Let's go to our handout to look at some past questions. Let me share the class notes. What was your class notes? Class materials. Okay. Okay. So can you see my new screen now? Now, if you can see it, let's look at this question together. The first question, it says that the conceptual framework specifies the fundamental reasons why financial statements are produced worldwide, which is to satisfy the requirement of external users. Now says required. Outline 5 types of economic decisions for which financial statements are likely to be used and identify 2 advantages of conceptual framework. This was for 10 marks, and they asked this question in 2020. So if you had revised what I've taught you, you can get the economic decisions that users want to make. If you remember those primary users, investors, lenders, other creditors. Investors want to make decision on whether they should buy or sell the company shares. They want to make a decision on how they want to vote during annual general meeting. Lenders want to make decision whether they should lend the company more money. They want to make decision on whether they should go after their existing borrowings, right? Creditors want to make decision on whether they should give the company additional trade credits or whether they should not, depending on what they can see in their financial information. And I told you about the advantage of conceptual framework. The very first of which is that it ensures that there is coherence and consistency in the process of developing accounting standards. And also it ensures that similar items are actually treated in a similar way. And also it helps in the treatment of unusual transactions and some other advantages that I gave you. So you can get this solution in your notes directly. In 2018, they also asked us, they said in Nigeria, financial statements are reported in more detail in both words and figures following the introduction of IFRS. You are required to explain the qualitative characteristics of financial statements reported under IFRS and assess how they make the information very useful. So they say you should explain relevance, explain comparability, explain understandability, explain faithful representation. 6 marks. I believe this is a free 6 marks for you from what I've explained to you in this class. So if you haven't revised what we read, what we have done here, please go and revise it. So I will not really go over it again. I've even gone over it when we started this class. In 2019, if you look at the requirements straight on, the examiner says, explain the meaning of each of the following concepts: substance over form, going concern. So they are giving you 3 marks each. I've already explained substance over form last week, and I've explained it again today. These are free marks for you in the exam. So please go and check all of these things. And there was a question similar to what they have asked before. This one says that X Limited commenced business on 1st January with a single item of inventory, which cost 10,000. It was sold for 14,000 in cash. And I said during the year, general inflation is 5%, and specific to the item was 10%. And I said required. Calculate profit in each of the capital maintenance concepts. Okay, if they're asking us to calculate our profits in each of the capital maintenance concepts, there is the financial capital maintenance concept, and there is the physical capital maintenance concept. Under the financial capital maintenance, our sales is 14,000 because that's how much we actually sold as of today. But the cost of the asset as of January under the financial is 10,000. Under the physical is 10,000. Let me put it in bracket, being cost. But the physical looks at the operational capability or capacity of the business by considering inflation. Of course, it will consider the specific inflation to the item, which is 10%. If you do 10% of 10,000, that means the cost as of today has increased by 1,000. Such a way that my profit under the financial capital maintenance, this one will say is making a profit of 4,000. But this one, being true to himself, will say we have only made profit of 3,000. That's the difference, like I've explained before, between financial concept of capital or capital maintenance and the physical capital maintenance. In 2022, they said that the IAS conceptual framework for financial reporting gives much detail about the qualitative characteristics of financial statements, which makes them useful. Required. Discuss the qualitative characteristics which makes information useful to users. 10 marks. So really, majorly, the examiner wants you to talk about the fundamental characteristics because that's what makes the information useful, both the relevance and faithful representation. That's what they want you to talk about. Then you can then give them a simple glimpse about the ones that makes it even more useful. The enhancing qualitative characteristics, then you talk about those 4, but what is really looking at is the fundamental characteristic. The B part says that the conceptual framework of IASB states that there are 2 concepts of capital maintenance. Explain the term financial capital maintenance and physical capital maintenance. I told you that financial capital maintenance looks at capital maintenance as when you have made profit, and it's the difference between your opening and closing capital. But physical capital maintenance looks at your productive capacity. And if your productive capacity has improved between the end and the beginning, then you have physically maintained your capital. And it also considers inflation. This one is professional. So question 7, it said an important aspect of IASB's framework for the preparation and presentation of financial statements is that transactions should be recorded on the basis of their substance over their form. You are now required to explain why it is important that financial statements should reflect the substance of the underlying transactions and describe the features that may indicate that the substance of a transaction may be different from its legal form. So if a question is asking you to explain why it is important that a transaction, that financial statement should reflect substance over legal form, you need to tell them that according to the fundamental characteristics of faithful representation, that an entity cannot faithfully represent its transaction if those transactions are not presented in accordance with their substance over legal form. So for you to faithfully represent, you must present your transaction in accordance with their substance. And examples of features that indicate that substance of a transaction is different from its legal form. The very first one that I've told you in this class before is where ownership is different from control. Is where ownership is different from control. That's a major feature, that substance is different from legal form. Or where you have options in a transaction. When you sell an item to somebody and you have option to buy it back, when there are options in a transaction, there is more likely that ownership or substance of that transaction is different from the legal form. Or when you sell an asset and you are still using that same asset, it also indicates that ownership might be different from, or substance might be different from, legal form. Number 8. This one says that Wasiu's activities include the production of maturing products, which takes a long time before they are ready to retail. Details of one such product are that on 1st April 2009, it had a cost of 5 million and a fair value of 7 million. The product will not be ready for a retail sale until 31st March 2012. It now says that on 1st April 2009, Wasiu entered into an agreement to sell the product to Easy Finance for 6 million. The agreement gave Wasiu the right to repurchase the product at any time up to 31st March 2012 at a fixed price of 7,986,000. At which date Wasiu expected the product to retail for 10 million. The compound interest Wasiu would have to pay on a 3-year loan for 6 million would be year 1, 600, year 2, 660, year 3, 726. This interest is equivalent to the return required by Easy Finance. Assuming the above figures prove to be accurate, prepare extracts from the income statement of Wasil for the 3 years to 31st March 2012 in respect of the above transaction, reflecting the legal form of the transaction, and also reflecting the substance of the transaction. Note, statement of financial position extract are not required. The following marks is provided as guidance for this requirement. Number 1, 2 marks, number 2, 3. Just 5 marks for questions like this. You want to kill them. Okay. What are they asking us to do here? They give us some things, and the examiner is wanting us to prepare statements using legal form and using substance. So, and they even say, assuming the above figures prove to be accurate, prepare extract of income statement of Wasil for 3 years. So, Wasil, income statements for 3 years, that is March 2010, March 2011, March 2012, then it'll be the total. Okay, and how did I get March? Because everything started in April, and the year end would be March. Since the beginning is April, the end will be March. So the end of the first year will be March 2010, the second March 2011, the third, like that. Okay, so let me start with legal form. So let's say I'm preparing using legal form. So let's read to understand the question first. So Wasil's activities include the production of maturing products, which takes a long time before they are ready to retail. It's a detail of one such product on 1st April 2010, which had cost 5 million. So this is the cost of the product and a fair value of 7 million. And this product will not be ready until March 2012. So we cannot really sell it until March. And I said in April, Wasil entered into an agreement to sell this product for 6 million. So that's, as far as legal form is concerned, the guy will say he has made the sales. For the fact that he just entered an agreement, even though whether the person has bought it or not, doesn't concern him. What is important is there's an agreement, and that's legal form. He will ask, is there an agreement? Say yes. Good, I've made money. So he entered into an agreement to sell the product for 6 million. And Wasil has the right to buy the product back up to 2012, and he can buy it back for 7.9 million, at which date he can retail it for 10 million. Okay, so if I buy the product back, I can sell it again for 10 million. However, don't forget that this agreement that I entered in 2009 to sell this product for 6 million with this guy, don't forget that it cost me 5 million to produce. So my cost of sales is actually 5 million. And they say that this agreement includes that I can buy it back from me.
And give up.
For 7986, and I can sell for 10 million, which is this. So that means my total sales over the 3 years what's 5 million plus 79, whatever? That would be 12,986. So what's my gross profit for each period? This is the time when you guys need to bring out a calculator and give me figures, please. So what's gross profit? This should be 1,000. Nil. So how much is this?
2014.
2014. I guess this should be 3014. Since I can easily add these two together. Are there any other operating expense based on legal form? Can't see any. So my net profit remains the same. But using the same approach for substance, I just copy and paste it. So for substance, this revenue he says he has made does not exist as far as substance is concerned. Because he will say, okay, you haven't made money. For the fact that you enter into an agreement to sell doesn't mean you have actually made money. So as far as substance is concerned, you have actually made money only when you have actually sold, which is this 10 million here. When it's sold. So this 10 million here can easily fly as sales, and the costs is not the repurchase price based on the agreement. It is the historical cost here. That's how we record in reporting. We don't use repurchase price, we use the historical. So that means that our gross profit here is 5,000. However, don't forget that this guy actually entered an agreement with Easy Finance and he collected money from Easy Finance, even though he did not give him goods. The goods will not be ready until 31st March, but he collected money. So, and they told us indirectly that substance will say that money you have collected, because you say you sold to somebody, you agreed, but the goods is still with you. You did not sell. In fact, that money you have collected from that person is like the person gave you a loan, which you are supposed to account for interest on it. And that's why the examiner gave you these 3 interests. So in year 1, there will be an interest cost of 600 or 600,000. In year 2, there will be an interest cost of 660. And in year 3, there will be an interest cost of 726. Can you add this? What's 600 plus 660 plus 726?
1986.
1986. So our profit now this is a loss, profit or loss. This is a loss of 600. 600. So how much is this?
4274.
660, sir, not 60.
Second one is 660.
Sorry, 660. Thank you. 660. So how much is this?
4274.
Sorry?
4274.
4274. This will be a profit. So, how much is the total here?
Three zero one four.
3014. Okay, good. Now, one thing you should see in these
It should be
two.
4274, not 4247.
Okay, thank you. 4274. Okay. One thing I can note here is this. Both the substance and legal form, surprisingly, they both give us the same total profit over the period, because this is 3014 and this is also 3014. The difference is that for each year, it has different amount of profits. So for substance, there's profit at the beginning and there's profit at the end. But for legal form, this, I said for substance. For legal form, profit at the beginning, profit at the end. For substance, this one spread the profit over the 3 years in some way or the other. But what this question really wants to do for you is just to make you understand what, when we say legal form, I'll be shouting legal form, legal form. This is just a practical demonstration of legal form, that as soon as there is an agreement, he believes he has made a profit or he has made a sales. But for substance, it doesn't work like that. It looks at the economic and financial reality. Have we actually made a sale? Have we actually? So this is a question you need to really look at and be able to solve yourself. And the final question here, I would want you to go and try your hands on this one. Make some research. I've actually talked about it before. I've actually spoken about it before, so you can research on it again. So we are done with conceptual framework. Do we have any questions before we move to the next topic?
Hello, sir.
Yes, I'm with you.
Okay. Now my question is on the calculation that we just solved. I understood legal form perfectly, but substance over form,
Mhm.
where you said that he sold for 10 million, on the question they said that he expected.
Check the woman.
Sorry, can you scroll up to the question? Yeah, where we have 10 million. He said Wasiu expected the product to retail for 10 million. So my understanding of it does not really seem to be that he has made the sales already. Like it's an expectation. So does it mean that he has already sold?
Yes, so that's what we mean by substance. Since the question is asking for 3 years, so we are saying that in 2012, because that's when we can actually sell based on the reality of this company. And they are saying here that the selling price as of 2010 is 10 million when we can actually sell. So the issue here is not about whether you have actually sold or whether you have not actually sold. The issue here is, can we sell as at that date? Can we sell as at that date? And based on this question, what they told us is that yes, we are expected to sell for 10 million. So the economic reality or financial reality is that we will sell for 10 million, which is okay. You know, in accounting, we make use of estimates for our substance and make use of our judgment. So it's fine.
Okay, sir.
Good evening, sir.
Good evening.
Yes, sir. This substance over form, substance and legal form. The legal form, is it the same thing as substance over form, or is it something different? Because substance over form, I understand that one. Now, this one is talking about substance. Is it substance over legal form? Is it legal form and form? Is it the same thing, or is two different things?
So substance over form, there is the substance and there is the legal form. So substance over form is, there are two separate things. There is one that is substance and there is one that is legal form. And that's it.
No, the form is what I'm talking about now. Is it the form is the legal form now?
Yes.
Oh, okay. Thank you very much, sir.
You're welcome.
Okay, sir.
So we can move away from this topic if you don't have any other questions. Let me share the conceptual framework notes, working notes with you. Okay, maybe I'll share it later. So that I can add the solution of that one later also. Can you see my new notes?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Now let's move to IAS 16. We have like 1 hour, which is a very good time to explain some principles to you. IAS 16 on property, plant, and equipment. Okay, sorry. So now, for this topic, we are going to be looking at definition of PPE, recognition, subsequent costs, look at measurements, both initial and subsequent. We'll look at the recognition, then disclosures. Then we'll solve plenty past questions. Then we'll end. Worst case, we'll finish this class. After today's class, we'll spend 2 more classes. Then we'll be done with this particular class. So the first thing here is the definition of PPE, property, plant, and equipment, IAS 16. IAS 16 define PPE, says that PPE is any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes. And it is expected to be held for more than one accounting period. So that's PPE. That's the definition. Says PPE is any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes. Sorry, give me 1 minute, please. Okay. Okay, so PPE is any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes, and it is expected to be held for more than 1 year. So when we talk about property, plant, and equipment, the first thing here is that it has to be a tangible item, something that we can see or touch. And this tangible item must be held for use. You must hold it for use. You have to be using it within the organization. And using it for what? Number one is production. To produce whatever it is that you are producing. You have to be using it for either production. Number two, supply of goods or services. I mean, what would come to mind here would be like a delivery van. Even those internet company, those telecom company that lay cables to supply internet connectivity to their customers, those fiber optic cables they are PPE because they are using it to supply. whatever items that helps you supply your goods or service is PPE. Or it could be rentals to others. If you have any item that you are renting to others, meaning they will return it back to you, it's PPE. Rentals to others. And for administrative purposes. So if you have any item that you are holding for administrative purposes, it is PPE, meaning that you are using to run your business or your office, for your office to run properly, like your furniture and fittings, like your air conditioner, like maybe computer equipment, your printer, for administrative purposes. Those ones might not be used for production, they might not be used for supply, but without these items, you will not be able to run the office smoothly. That's for administrative purposes. And it is expected to be held for more than one accounting period. Before an item can be PPE, you must be able to use it for more than 1 year. If an item meets any of these that I've mentioned above, but you can only use it for 1 year or for less than 1 year, that's not PPE. You must be able to use PPE for more than 1 year. So when you have an item that meets this definition, whatever the item is, then that item is a PPE. Then how do you recognize this item in your books? IAS 16 says that before you can recognize it, it must be probable that the future economic benefits associated with the item will flow to the entity. And number two is that it must have a cost that can be measured reliably. These are the two recognition criteria for PPE. That when an item of PPE meets the definition we just mentioned, then you can go ahead and recognize it in your books. You can go ahead and record it in your books if it meets these two recognition criteria. Number one, it must be probable that future economic benefit associated with the item will flow to the entity. And of course, you know that before the future economic benefit will flow to you, it means that you have control over the asset. And it must have a cost that can be measured reliably. And costs could be the money you paid for the assets or the fair value of other consideration given to acquire the asset. If you did not pay, but you had to give us something to get the assets, what's the fair value of that thing? Or maybe they gave you for free. No problem. What's the fair value? What was the fair value of that item that they gave you for free? Or of that PPE? The core thing here is that before you can recognize it in your books, we must be able to get the cost. You must be capable of measuring it reliably. So when you want to record or recognize an item of PPE in your books, you simply do that by debiting that PPE. If you have paid money for that item, you simply credit bank, and it's possible that you have acquired it on credit. You have other payables, or they gave you for free. Let me ask you, if they have given you for free, that you didn't buy it, if you debit PPE, who can tell me what will you credit?
I don't know. Is it possible to credit our equity capital?
Well, yeah, good idea. Income, credit income. Remember, income is an increase in assets. If you remember that definition I gave you yesterday. Yeah. Okay. So this is recognition. Now let's go to measurement. Measurement talks about the amount that you're going to recognize that asset in your books. How much are you going to put the asset in your books? That's measurements. And when it comes to measurements, we have something we call initial measurement, which is the measurement at the date of the transaction, or at the date you acquire the assets. And there is what we call subsequent measurements, which is the measurements at the end of the year, or which we call reporting dates. Measurement at the reporting date. Now, let's start with initial measurements. Let's start with initial measurement, which is the measurement at the date of the transaction. So PP are always initially measured at cost, always. And every one of you will know what the component of cost is. Component of cost. I'll tell you like 3. So the cost of an item will be simply the purchase price. It's simply the purchase price. But you know that you can import an item. When you import an item, the cost of that item will also include what? Import duties. Abi? It will include import duties. And you buy an item, almost every country has something similar to VAT. You know, in Nigeria, we will call it VAT. Anytime you buy something, they always add VAT. What's the VAT rate in Nigeria now? Anybody?
7.5.
7.5%. But since this is an international standard, the standard calls it non-refundable purchase taxes. Non-refundable purchase taxes. It simply means VAT in Nigeria. And you see that these guys specified non-refundable purchase taxes because there are some VAT that are refundable. Because like in Nigeria now, you can claim some input VAT. If you buy some item, you can claim it, especially with these new tax reforms now. Most VATs are now claimable, whether for service, whether for assets. So most VATs that are on our invoice when we buy assets and all of that, you won't be able to add it as part of the cost of the asset anymore, since they will now be refundable in form of input. You can claim it back from the government. Meaning when you're remitting your output, you just net that input off. So you only remit the net. So the VAT you can add as part of the cost of your asset is the VAT that is non-refundable. So then you less trade discounts or rebates. That's another name for trade discounts. Every one of you should be able to sort this out. It's not something that should sound anything new to you. When we are talking about the cost of something, it should be the purchase price. If you are importing that item plus import duties, and there is always VAT. When you buy something, they always add VAT. So you add the VAT too, provided it's non-refundable. At least for now, as far as the current tax law is, most assets that you buy, the VAT on them are non-refundable. And if they give you discounts, then you can remove the discounts or you can remove the rebates. You have to be very careful with these discounts. Very, very careful. The examiner always tests it because they were very specific by saying it's a trade discount. You need to know the difference between a trade discount and a cash discount. Very different. You see, why trade discounts is okay. Victoria, go ahead, please, before I continue.
So I just wanted to bring your attention to the recognition definition. It says it must that the future economic benefits. I'm lost, sir.
Okay, I'm sure I mentioned it rightly. So
Thank you, sir.
Victoria, focus on the one I'm talking about now. So trade discount is A reduction in price. A reduction in price for bulk purchase or for being a first-time customer. So when somebody just reduce price for you because you were the first that came to buy from me and all that, or you bought in bulk, then they give you a discount. That's a trade discount. So when they give you such a discount, you see that reduction on your invoice direct. This is different from cash discounts. Cash discount is an early settlement discount. Is an early settlement discount. Is a discount or a reduction in price given when you pay early. So in this wise, it means that this discount is not something you will get for sure. You are not sure whether you will get it or not. You might get it, you might not get it. That's early settlement discount. That if you pay early, you will get it. If you don't pay early, you won't get it. So because the discount is conditional, it's not something you can remove from. It's not something you can remove from your price now. You don't remove it. So it's just like you bought an item from a supplier. The guy said your price is 20,000. And he said that, I'm giving you a discount because you are my first time customer today, so I'm giving you 1,000. So your net price is 19,000. So automatically, like at the moment today, you pay 19,000. This is a trade discount because you get it immediately. In fact, when you're entering in your books, what you enter in your books is 19,000. That's why we less trade discount. But if it's one whereby they say that the purchase price is 20,000 and we'll give you discounts of 5% if payment is made within 1 month. In this case now, your purchase price is 20,000. Your purchase price is how much? 20,000. This one is conditional. It happens in the future. But for this one, they give you this one immediately. That's what we call trade discounts. You get it instantly. So your purchase price is 19,000. But for this one, when they will give you discounts of 5%, if you pay within 1 month, you won't consider that. Your purchase price is 20,000. Any question on that? Any question on that?
Yes, sir. Good evening, sir. I didn't really get the difference between the trade discount and the cash discount.
Okay, no problem. But I wouldn't want to just say what I've just said before. So what did you hear me say? Instead of just repeating myself again, where exactly did you hear me say? So I can know where I want to help you from.
Okay, it's just from the part of where you said one is for when you pay on time, and the other one is for I think for first time customer. I didn't really get that difference.
Okay, no problem. So please pay attention now, because if you're listening to me, you will have really understood it. So very straightforward. A trade discount is when you buy in bulk, they reduce your price for you, or you're a first-time customer, they reduce your price for you. They give you immediately. That's trade discount. For cash discounts, that one, if you pay early, they will reduce your price. So that one is conditional. If you pay early, and I give examples that if you buy goods for 20,000 and the guy gives you a discount and say, okay, I'm removing 1,000 for you, so pay 19,000 instantly. So this is a trade discount. It's given to you instantly. It's not conditional on anything. So the guy just gives you either for whatever reason. So all those promotions like buy one, get one free, they are all trade discounts. You get it instantly. That's trade discount. You get it immediately. That it is shown on your invoice that we have given you discount to that this is the amount you pay net. And that's what I'm saying now. That if you buy an asset like this, that the purchase price of the asset is 19,000. But if it's a scenario whereby they say the purchase price 15, but we are giving you 5% discount. If you play, we are giving you a discount of 5%. If payment is made within 1 month, this is an early settlement discount. This is a cash discount. We are not going to consider this. We won't reduce it from our purchase price, meaning our purchase price remains 50,000. That's what I've said. I just repeated myself again.
Thank you, sir.
But I want to look at something. Even though in this case, the purchase price remains 20,000 because this discount is a future discount. It's something we are not sure that we'll get it or not. So you will not then go and reduce the cost of your assets with that. Let's say after 1 month, you now met this condition that you now pay within that 1 month. Right? So that means the guy will give you the discount. So how much discount are you collecting now? You'll be collecting 5% of 20,000. How much is that? That should be 1,000.
1,000.
Yeah, that should be 1,000. So how are you going to treat this 1,000? Where will it go in your books? Who can tell me? Where will this 1,000 go in our books?
That should be discount received.
Thank you very, very much. Fantastic. Discount received. Thank you. It's an income. Correct. It's an income. Good, good, good. Okay, I just wanted to be sure that you know that. Okay, don't forget that we are still talking about costs. And all I've spoken about is just purchase price, import duties, plus non-refundable purchase taxes, less trade discounts or rebates. I just took time to explain trade discount and cash discount. That you need to pay attention. Remember that what we deduct is the trade discount. And it was Dami, I can't remember her name, that she said she could not understood. And I explained it again, that trade discount is the discount they give you outrightly, immediately. Cash discount is early settlement, is conditional, is in the future. We don't get that immediately. But if you now happen to get it, then Dami told us that it becomes an income. It won't be a reduction in your costs like this one did, like the trade discount. It becomes an income. You treat it as an income. Okay, so number 2, I'm done with number 1. Still on component of costs. Number 2 is costs can also be directly attributable costs of bringing the assets to its location and condition for it to be capable of operating in a manner or in the manner intended by management. So another cost is directly attributable cost of bringing the assets to its location and condition for it to be capable of operating in a manner intended by management. So that this goes to show that when we say cost, is beyond just the cost of buying it and the import duties and all that you get, the discount and the rest. It includes the cost of making the asset work properly, the cost of bringing it to its location and condition for it to be capable of operating in the manner. And examples of such costs will be We'll be looking at costs like initial delivery and handling costs. Initial delivery and handling costs. So when you buy an asset, you need to deliver it now. You need to transport it. It's part of the cost of the asset. Or handling costs. If you had to package the asset to protect it while you're bringing it to your location, or police or Agbero people stopped you on the road and they collected some money from you to enable passage, whatever cost you incur in between, handling costs, initial, or maybe you had to pay insurance, like a flight insurance, just for the period when you would take it from that location to your location. Handling costs. So initial delivery and handling costs. Another one is installation and assembly costs. So when you take it to your location, it has to be able to operate in the manner that you intend it to operate. So you need to do some installation, or you need to assemble it. You now paid some people to do that. That's installation and assembly cost. It's part of the cost of that asset, or probably that asset requires professional fees, especially when it has to do with building or a land, when you need architects, lawyers to draw up some agreements or draw up some design. It's part of the cost of that asset. Or you need to prepare the sites where the assets will be located. Site preparation costs. If it's a land where you have to clear the land to erect a structure, if it's a generator where you have to do a pavement or a cover for the generator to enable it stand properly, site preparation cost. Also, employee benefits that are directly attributable to the acquisition of the assets, that are directly attributable to the acquisition of the assets. If you have some staffs that helped in getting the assets ready, that helped in transporting the assets, that helped in installing the asset, the salary of those staffs for those period or for those days should be added to the cost of the assets. It should not be expensed. it should be added to the cost of the asset. Employee benefits that are directly attributable to the acquisition of the asset. Also, if there are any pre-production testing costs, if you have to test the assets to be sure that it's operating in the manner it should operate, any cost incurred in that testing is part of the cost of the asset. Just that when you now test an asset, you now see that the asset works properly. But of course, since you tested, maybe the asset is like a machinery or a plant that you want to be using to produce some goods. So you bought materials, you labor and all of that. Those costs of material and labor, we are saying those costs are actually testing costs and they should be capitalized, right? However, what about the products that you get from those assets? If those products are sellable, you're able to sell it, can you treat the money you get from those sales as income or as revenue? No, you cannot. Because when those items were produced, the asset was not actually ready for use. It was still in the testing phase. For that reason, the income or the money you got from selling the samples that was produced when you were testing, you simply remove it from the cost of the asset. So less sales proceeds from sales of samples. These are the 6 examples mentioned in IAS 16. You have to know these 6. Every of my students always know these 6. From initial delivery and handling cost, to installation and assembly cost, to professional fees, to site preparation costs, to employee benefits that are directly attributable to the acquisition of the assets, then to pre-production costs, less sales proceeds from sales of samples. All these costs, you add it as part of the cost of that asset. Now, the following costs are not directly attributable. I need to mention this to you because you need to be able to, in case the examiner wants to be sharp, they are now giving you some costs you have not seen before. You need to know that when we say directly attributable cost of bringing the asset to its location and condition, they are majorly assets incurred to get the asset ready for use. Immediately the asset is ready for use, any cost that is incurred after that time, after the asset is ready for use, such costs are not capitalized. Such costs are not directly attributable. Such costs are expensed. So examples of costs. The following costs are not directly attributable. Examples of costs that are not directly attributable. Number 1 is the cost of opening a new facility or startup cost or similar pre-production cost. Meaning that the asset is ready for use, but you decided that you want to do an opening ceremony for the assets, or like a startup cost. The asset is ready, you just want to incur some other peripheral cost that has nothing to do with that has nothing to do with the workability of the assets. The asset is already ready. You are just the one that wants to, or pre-production cost before you start production. The asset in itself was actually ready for use. These costs are not capitalized, or the cost of introducing the products to the market, like advertisements and promotional costs. We have to do advertisements for the product of the assets. Those ones are not directly attributable costs. Or relocation costs. If you have to relocate some staffs that will use the assets, or you have to do staff training. The asset is ready, but your staff don't know how to use the asset, so you needed to train them. Those ones are not directly attributable costs because the asset is ready. It's your staffs that don't know how to use the assets. Or general and administrative expensive. These are also not directly attributable. Or initial operating losses. When you started using the asset, it was not operating to capacity, so you were making losses. Those initial operating losses are not directly attributable. So you need to be careful of these 5 or 6 costs. Don't think they are directly attributable because they are not. These are the directly attributable costs. Number 3 is the cost of removal, dismantling, and restoring the sites on which the assets was located. We call that the commissioning costs. The commissioning cost. So if there is a regulation in the country where you operate that this type of assets that you are installing, at the end of its useful life, you must remove it or dismantle it and also restore the site on which the asset was located. So we call that the commissioning cost. Even though this cost is a future cost, because it's not something you're going to incur now, it's a cost you would incur in the future. Because of that, you will need to discount it to present value. Is the present value that you add as part of the cost of the assets. So this cost must be discounted to what? To present value. I mean, you are learning something new today, that in reporting, anytime you hear me mention future value, anytime you hear future value, immediately know that we do not recognize future value in our books. That has to be discounted to present value. You hear me mentioning it in a lot of places. Immediately I mention future, any cost you incur in the future, we will always discount it to present value. Always. And a typical example is this. So I will show you how to do those discounting when we solve questions. Somebody raised up his hand. Can you go ahead with your questions, please?
I wanted to ask for explanation more about that discounting, but you said in the future we'll know, so that's why I reduced my hand.
Oh, okay. When we solve questions, I will show you how to do that. Joseph?
Yes, sir. So my question is this decommissioning cost that will be discounted to the present value. Now, supposing that during the decommissioning, that issue of inflation has set in, how will it be treated?
Well, we operate historical cost basis of accounting, right? So we don't take note of inflation. Yeah.
And also, sir,
Okay.
like you said, every other cost aside the directly attributable cost should be expensed.
That's correct.
What about in a case where a cost is incurred and then it increases the economic value of the assets? For instance, like a motor vehicle, changing as in buying new engine entirely, and then also like a building, roofing a building. So such costs, will it still be expensed?
No, it will not. So that's going beyond initial measurement. I'm still on initial measurements. The cost that you incur at the initial stage of the asset, when you're just getting the assets ready for use. So when the asset, you know that there are some instances where an asset is ready, but you are not using it. It's just there. Like maybe you are renting, you are trying to get the place where you put it ready, or you are training staff, you are relocating staff, you are doing marketing, you are doing opening ceremony. Cost at the initial stage. The one you're mentioning, I'll still get to it, which is subsequent cost, meaning after you have started using the assets,
Oh,
there are
okay,
some
sir.
costs
Okay,
you
sir.
would incur later. So I would get there.
Okay,
Uh,
okay, sir.
okay, I have 3 minutes
Okay.
more.
Thank you, sir.
You're welcome. I have 3 minutes more, so let me just mention this and close up. The last one is borrowing costs. Borrowing costs that are directly attributable to the acquisition and construction of the assets. So if you borrow money to buy the asset, okay, if you borrow money to buy the asset, you see the interest you are paying on that borrowing should also be added to the cost of the asset if it is a qualifying asset. That is, and when we say qualifying asset, we are talking about an asset that takes a long time to get ready, or an asset that you construct yourself. If it is an asset that you bought off the shelf that is already ready for use, that one is not a qualifying asset. So we are talking about an asset that you construct, that it takes time to get ready. So any interest you are paying on borrowings to finance such an asset, the interest you pay on such will be added as part of the costs of the assets. These are the components of costs. My dear students, you need to know these four. They can ask it in the exam. They have asked it before, not even they would ask it. Everything I've mentioned here are potential past questions. Even this one, they have asked it before for 4 marks. They said, according to IAS 16, mention costs that are not directly attributable. They have asked this one severally. So I will stop here for today. Learn it. I will share this my working notes. Next tomorrow, it's even tomorrow. Tomorrow we're going to go very far in the evening. So a lot of you, that evening classes, I can see some of you usually miss that class. You should not be missing it. It's extremely important. So tomorrow we'll be starting from, I think, 7 and to 9. So tomorrow I would explain all the principles, all the remaining principles. So if you miss tomorrow's class, I don't know. I will explain subsequent cost. I will explain subsequent measurement bases. I will explain the recognition. These are key things. So when I'm done with the explanation, if we still have time, I will solve few questions. Then on next week, Saturday, then we'll just solve questions. We'll just spend the whole day solving questions, more questions, and that will be the end of IAS 16. And we'll move to another topic. So I think another topic should be IAS 38. Then we'll move to another topic like that. Then I think August, we'll move to group account. Group account should not take us 5 classes or 6 classes. It's a very straightforward one. Then we'll come back to standards. Then we'll continue to move, right? So we have a complete picture of where we want you to be in the very short term. We have it. And it's just very important that you also have that picture as well and be able to follow through as we are teaching you and reading these things as fast and as quickly as possible. That will be very helpful. So thank you very much for your attention. I will see you tomorrow. Bye for now.
Thank you very much. Bye.
Thank you, sir,
Thank you,
for
sir.
detailed explanation. We are grateful.
Thank
You're
you very much, sir.
You're welcome. Bye.
Thank you, sir. Have a lovely night.
You too. Bye.